Welcome to Finbot Insights. There's a story being told to income investors about covered call funds. It's a popular sales pitch, and it is dangerously misleading. It's a narrative designed to separate you from your capital. And in this analysis, we are going to expose precisely how it works. So here's how we're going to break this down. We will proceed in 5 distinct stages. We'll start with that seductive story, the pitch itself. Then we'll peel back the layers to reveal the flawed mechanics behind the curtain. And we'll end with a final, incontrovertible verdict. Okay, let's first examine the core of the sales pitch. It's a simple analogy, a story that financial pitchmen use to create a false sense of safety and reliability around what is actually a very complex and flawed product. And this is it. It's this hardworking, blue-collar metaphor. It's crafted to sound completely plausible, isn't it? They'll tell you the fund's net asset value, its underlying principal might wobble a bit, but that income? Well, that just rolls in like clockwork. And this right here is the foundational lie that we are going to systematically dismantle. To truly expose the flaw in this comparison, we first have to understand the actual business model of the asset they're using in the story, the delivery truck. We need to look at the real risk and the real reward. A real truck, as part of a profitable business, generates true additive income. This is real cash flow that covers all the operating expenses, the maintenance, and the vehicle's depreciation. It doesn't just preserve the owner's capital, it actively builds their equity over time. And this is absolutely crucial. The truck's business model has essentially boundless potential for growth. You can reinvest, you can scale, you can build a fleet. At the very same time, the downside risk is strictly limited, capped at the initial investment. All right, enough of the romanticized analogy. Let's pivot now to the cold, hard reality. We need to examine the actual mechanics of a covered call fund and observe how it truly performs in the real world. The data reveals a very stark reality. When the market is moving up, these funds get left far behind. They dramatically underperform the very benchmarks they are built on. And that's because, by their very design, they are forced to sell away their potential for significant gains, which means the opportunity cost for you, the investor, is immense. This chronic underperformance leads to a destructive process known as NAV erosion. This is the hidden cost of that high yield. The fund strategy forces it to sell off its future growth, systematically eroding your principal value just to generate the distributions it promises. Let's be perfectly clear on this point. These distributions are not additive income, like a truck's delivery fees. Instead, they often represent the slow, methodical return of your own decaying capital, a conversion of your principal investment into cash flow that depletes the source. Now we arrive at the core of the argument. We are going to systematically expose 4 brutal mismatches, 4 fundamental points of failure that make this comparison not just inaccurate, but intellectually fraudulent. These are the 4 points that the sales pitch conveniently ignores: the very illusion of its income, the hard cap on its upside, the unlimited nature of its downside risk, and your complete lack of control as an investor. The first mismatch is the very nature of the income. With the truck, you have real income that offsets depreciation and builds equity. With the fund, that income is cannibalistic. It's consuming the asset's future to fund today's distributions. The second mismatch is growth potential. The truck owner can build an empire from a single asset, but the fund holder is leashed to mediocrity. A hard cap on gains at the strike price prevents you from ever participating in significant market rallies. It's forfeited by design. Mismatch number 3 concerns downside risk. The truck analogy falsely implies safety. The reality is that the fund carries uncapped market risk. A business owner has limited liability. The fund investor is completely exposed, absorbing the full force of any downturn. You are naked in the storm. And finally, the 4th mismatch, control. The truck owner possesses agency. They are in control of strategy, operations, and their exit. The fund investor, in contrast, is merely a passive passenger in a structurally flawed vehicle with no ability to steer. Having deconstructed this analogy and exposed its core deceptions, we can now arrive at a clear and actionable conclusion. This is about reclaiming your financial road from these flawed narratives. This all boils down to one critical question that every income investor must ask. Are you receiving real income from a productive investment, or are you simply being handed back pieces of your own principal as it slowly liquidates? The essential takeaway is this: Your money deserves velocity and uncapped potential. This truck analogy is a manipulative tool used to steer your hard-earned capital into a vehicle that is ultimately designed for a rigged route to ruin. If you found this analysis valuable, we encourage you to click like and subscribe to Finbot Insights for more. However, let us be absolutely clear. This explainer is for informational purposes only. It is not financial advice. You should not trust financial advice from social media influencers, and that includes this channel. Always conduct your own due diligence and consult with a qualified professional.